Alright, so I just got done watching Trey Trade's interview with Jordan Bellfort, and guys, I gotta say, I was really impressed. I liked all of the questions that were asked, I liked what Jordan had to say, and I believe that there's a lot that you can learn from this, so that's exactly what we're gonna be doing in this video. Let's break it down, and I've got 4 key takeaways that are really crucial and could help all of us as investors moving forward. If you don't have a full 40 minutes to go watch the video, you're in the right place. We're going to go over the 4 key takeaways and really what they mean and how they could help us moving forward. So if that sounds like something you're interested in, let's get started. What's up, everybody? I'm Clay. I'm here to make 2021 the best year ever. If you haven't clicked that subscribe button yet, make sure to subscribe to the channel, join the channel, and become a bro. All right, now let's break this down. Let's break the interview down between Trey Trades and Jordan Bellfort because I truly believe that there's a lot of value in that interview. I mean, look, Jordan is an incredibly smart guy. It obviously shows in the way that he talks and what he talks about. Trey had some excellent questions. Man, that dude was on his game. He knows what he's doing. But there might have been some stuff, you might have got confused. It was a long interview. Maybe you didn't have all the time to watch it. Whatever it may be, there's 4 key takeaways that I believe that we could all use moving forward to help grow our portfolios and really to help us become better investors. All right, so key takeaway number 1, they talked about AMC and GameStop and the dilution of shares. Now, this is important because we talk a lot about this on this channel. AMC, GameStop, the companies like that, and the fact that they want to issue new shares in this secondary offering. Now, Jordan offered some great insight saying that CEOs and executives of these companies have a fiduciary duty to investors and to shareholders. So he does believe that AMC and GameStop will issue these new shares, diluting current shareholders. Now, he made a very good point, and I completely agree with it, okay? The executives at AMC, the executives at GameStop have a fiduciary duty to shareholders. Now, what does that mean? That means that executives have to act in the best interest of the shareholders, and they have to act in the best interest of the company. Okay, now this doesn't necessarily mean keeping the share price inflated at, elevated levels. And we currently know, and there's no doubt that GameStop and AMC are trading above expectations and above price targets. Okay, you can look at book value all day, and it would be, you'd have a very hard time arguing that AMC and GameStop are trading at the values or their book value per share. Right? We know the stock price is elevated. So the company, these executives are wanting to take advantage of this by offering additional shares at these elevated prices. Now, because they're trading at such high levels, they can essentially go out, offer these new shares, and bring a ton of money into the company to help grow the company. Right? Now, in the long term, this looks like an excellent idea because they're essentially getting cheap money, right? The shares trading above value, and they can go out there and they can sell it for a lot more than it's technically worth. Now, I do agree with this. I agree that this would be a great thing for the company if it could get, a value that's 10 times the current value of the share. If they could sell the share for 10 times its current worth. I mean, think about it. If AMC stock was actually worth $9 or $10 per share, and AMC could go out and sell that share for $100, everybody would say, well, that's a great deal, right? Go sell it for $100 and bring in that extra money. That's exactly what's happening here. They're saying that AMC is worth $2 per share, so why not sell it for $10 per share and bring in all of that extra money? GameStop, it might be worth $10 per share, but it's trading at $160. Why not sell it and bring in all that extra money? So that's what's going on here, and yes, these executives do have that fiduciary duty to help the company, grow the company, pay down debt, make it leaner, whatever it is that they're going to use that money for to benefit the company in the long run will essentially benefit the shareholder. Now, a lot of people are holding AMC and a lot of people are holding GameStop to squeeze out hedge funds. There's a complete disconnect from, that rationale to value investing rationale. right? If you're holding for a hedge fund squeeze, the issuance of new shares is not something that you want to see. Now, if you bought in early and you think that these new shares could, if you bought in at a very cheap price, these new shares could definitely increase the book value of the share in the long term, and it might help the company, grow the share price from that already deflated or from that low share price. But if they do offer these shares, the share price will come down. So keep that in mind when you're going ahead and when you're voting. Whether you vote yes or no, the executives at these companies want to issue the new shares. Now, this takes us to the second key takeaway, and the fact that he talked about a lot of people being disconnected from what's going on, and the fact that, government and inflation is essentially disconnected from the cash infusions that we're seeing in the economy. Okay, now let's break this down because this could get a little technical here, and we're not going to talk about it. We're not going to talk above people's heads right here, right? I don't want to sound, like I'm trying to be smart or anything. Let's break down what this means so that everybody can understand and we're on the same page. They talked about, kind of stagnated and lowered inflation since the dot-com bubble back in 99 into 2000, and then it's been low inflation and interest rates ever since. Now, the Fed currently has a target inflation rate around 2%. Now, inflation basically just means that every year you should expect the prices of a basket of goods, everyday goods and services that we use, to increase by about 2%. Okay, that's what inflation is. Your dollar last year is worth 2% less, or the dollar last year into this year will buy you 2% less, right? Because the price of goods increased by 2%. So if you did not invest that dollar and you earned a dollar last year, that dollar last year is going to buy you 2% less than it should this year. That's the target inflation rate, okay? Now, here's the thing, okay? We know a lot of money has been transfused and infused into the economy because of all the stimulus measures, right? Now, we should expect to see very high levels of inflation because a lot of people have a lot more money. There's a lot more money in the market, so therefore you should be able to pay more for goods and services. That is how inflation works. The more money there is in supply, the more expensive goods and services should be. Now, here's the thing. Here's the thing that I'm not convinced is actually happening, okay? The Fed is reporting that inflation is around the 1.6 to 2% level as they hope. But I don't believe that this is the actual case, okay? Now, yes, they measure a basket of goods and services, but Jordan brought up a great point. If you go out and you look at the housing market right now, if you look at the price of lumber, okay, maybe you're not going out and you're looking at all these prices, houses have risen much more than 2%. If you're going out and you're buying used cars, if you're going out and buying a car, the price of these things have increased much more than 2%. I mean, the price of lumber is up like over 200%. If you're going to go buy a house, it is much more expensive right now than it was before. Why? Because people have such cheap access to money. You can borrow money for almost zero interest right now. And when people can borrow money and they can spend beyond their means, okay, because it's cheap. You go out and you borrow $100,000 and you only got to pay back, a couple $100 a month to borrow that. It creates a disconnect between what's actually going on, what you're going out there and buying, and the value of that asset and how much you're paying for it. And he used an example in the luxury house market. He said you can go out and you can buy, a $10 million house and you put $2 million down and then you're only paying 20 grand a month to live in that house. And okay, those are numbers that a lot of us aren't going to understand, because we don't have $10 million. We're not going out and buying $10 million homes and things like that. But look, you get the picture, okay? When you have access to something that should otherwise be out of your reach, that's a recipe for disaster, okay? And it led into a great conversation that he continued to have with Trey Trades there. And he started to talk about what could happen if the inflation rates rise, if inflation goes up and interest rates go up. Now, this leads to the next key takeaway, and that is the fact that markets are cyclical. Now, what do I mean? Markets are cyclical in the fact that they go up and they go down. okay? Bull markets are followed by bear markets, and bear markets are followed by bull markets. Now, if you're brand new to investing, or even if you're not brand new, but you've been investing for, let's say, less than 15 years, you don't really know what a bear market is like. If you weren't in the market through, 2007 through 2009 at the bottom of that bear market, you don't know what a bear market is. You've only experienced a bull market. And the great thing about bull markets is everything goes up. Okay? It really doesn't matter. If you're buying decent companies, it doesn't matter when you buy them in a bull market because they're going up. Now, the thing is that when inflation kicks in, and if inflation and interest rates do rise, this could lead, and this is how the bear market could happen, okay? Let's say that inflation goes up to, say, something ridiculous. Let's say interest rates right now are 1 to 2%, okay? If you're going to go to the bank and you're going to try and get a money market, let's say you can get away with a 1 to 2% money market account. You're very unlikely to invest your money in that 1% interest rate, because you can go out, you can invest in the stock market and generate relatively safely a 10% return, right? If you want to average in the S&P 500, you can generate roughly a 10% return. So why would you put your money into just a basic interest rate at 1%? Now, let's say that inflation starts to increase drastically, it gets out of hand, and interest rates, the Fed would go ahead and raise interest rates to counteract inflation, and you can now invest in the bank for 20%. Okay, 20% that might sound unheard of, right? But it's not. You can go back and look at historical interest rates, historical inflation rates, and we lived through. I haven't lived through 20% interest rates, but Jordan was giving a very good example of how back in the 70s, interest rates and inflation were like 20%. Okay, you can go back, you can check on all the historical graphs and everything. It's true. It was out there. So let's say that interest rates and inflation rose to 20%. Now, this isn't unheard of, because if you go and look at some of the articles that are written on how much money was actually infused into the market with all these stimulus measures, the money supply increased by about 24%. That means just in the last couple of years, there's currently 24% more money in circulation than there was prior to the pandemic. Okay, this is a recipe for inflation if you're looking for one, right? So interest rates and inflation are being artificially kept low right now. It's a necessity. The government needs to do that, right? But let's just say that interest rates rise to 20%. Now, you have the choice. You can go ahead and you can invest your money in a bank account, in a savings account, where you're going to get 20% interest. Or you can invest in the stock market, where you're going to have an average of 10%. Nobody's going to be investing in the stock market when interest rates are 20%, just like nobody's going to be investing in interest rates when they're 1%, right? Vice versa. So if inflation rises, if interest rates go up, money is going to be pulled out of the equity markets, out of the stock markets, and into interest rates and bonds, okay? These are cyclical happenings, right? Bear markets into bull markets into bear markets. So when that happens and we're in a bear market, stock prices go down. And this is something that you really need to think about. They explain it in a very good way. Jordan, he explains it in a very good way, and I recommend going and watching it. If you haven't watched the interview yet, make sure to go check it out. It's something that you definitely need to see. And finally, key takeaway number 4 is the fact that there is still a lot of money to be made in this market, right? He doesn't say that you need to be afraid. He doesn't say that a bear market's going to happen tomorrow. But look, there are things called speculative plays and there are things called conservative plays. And he makes a very good differentiation between the two, and he had some advice, right? If you're going to be a conservative investor, you're going to be much better off, and this is coming straight from Jordan, right? And I agree with this too. If you're going to be a conservative investor, you're going to be much better off strictly investing in an ETF that tracks the S&P 500 or one of the sectors, one of the spider ETFs out there that tracks a certain sector and industry. You're going to be better off doing that than you would going out and, let's say, picking 10 stocks on your own. okay? If you're looking for roughly a 10% interest rate, excellent. Go that route. Be a conservative or prudent investor, awesome. If you're a speculative investor, if you're investing in companies that are overvalued, right? You don't necessarily, if you're a conservative investor, you're more likely looking at the value of a company and investing based on that. Think Warren Buffett, okay? If you're a speculative investor, you're investing in plays like GameStop and AMC stock and these things that are technically overvalued when you're looking at book value of a share, but there's a lot of money to be made on these companies and on these trades. But here's the thing that he said. One, you need to make sure that you stay connected and you stay on top. You can't just, he put it very well, you can't just dabble in speculative plays. And I completely agree with that. If you're going to be investing in stuff where you want to make fast money, obviously the opportunities are there, but you need to make sure, one, that you know what you're investing in, and two, you stay very up to date on what's happening with your investments. It's not a buy and hold forever type deal. You need to make sure that you stay on top of really what's going on with these speculative plays. And number two with these speculative plays is that they do not last forever, right? Let's think about AMC and GameStop. AMC and GameStop, the value of these shares are overinflated. We know that, right? Now here's what happens and what would happen with all companies and all shares that reach this level of inflated prices. Companies will come along, the executives with their fiduciary duties that we talked about at the beginning of the video, they're going to come along and say, man, this stock is worth $5 a share, but it's trading at $500 per share. We need to go out and issue more shares so that we can capitalize on that inflated price. It's the same thing that you would do. Let's say, you get your Charizard Pokemon card, right? And the Charizard Pokemon card is actually worth $100. But for some reason, people are willing to pay $100,000 for it right now. You're very likely to go out and sell it for that $100,000 because the price is well overinflated and there's a very good chance that it's going to come back down. And it's actually a little bit riskier than that with stocks because these companies have a fiduciary duty to the company itself and to the shareholders to take advantage of that inflated price, and they're going to go out and offer additional shares. Now, I know this video was a little bit longer than normal. The 4 key takeaways, make sure that you go ahead and watch that interview with Jordan and Trey. It was an excellent thing. I would highly recommend it to everybody. I really enjoyed it. I learned a lot from watching it and really just listening. I didn't have to watch the whole time. I was, listening as I was doing some other stuff. And it was very good. You can learn a lot from that. But the 4 key takeaways, make sure that you know that AMC and GameStop CEOs have that fiduciary duty to investors to offer those additional shares and bring that in. Investors and inflation are kind of disconnected from what's actually happening right now. Stock market happens in cycles. And finally, that if you are investing in speculative plays, you need to make sure that you stay on top of those speculative plays. Now, guys, if you're still here and you haven't started investing yet, but you're really getting inspired to do so, there's a link in the description below for Webull. It is super simple to set up your account. And if you do so and deposit $100, you're going to get a couple free stocks, and it's really going to help pad your portfolio right from the start. If that subscribe button is still red, make sure to do me a favor, subscribe to the channel, become a bro. We're here every single day and we're growing our portfolios together. And if you want to share this video, do so, tag me anywhere at ClayBro. I would love to follow you guys back and really see what everybody's interested in investing in. Now, until the next time, I hope that each and every one of you have an awesome day.